Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's June 13th. And I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. A lot of big stories this week, including Trump, Kim Jong-un signing a denuclearization deal for their countries. I'm happy this deal went down, but also a little sad. I don't know if Trump's going to be able to call Kim Rocket Man anymore. I thought that was one of the best nicknames. I love Trump's nicknames, by the way. Lying Ted, Crooked Hillary, Little Marco. He had like 15 or 20. Low Energy Jeb. I mean, man, this is our president, by the way. So I just think, I think it's funny. It's hilarious. You got to step back and you got to laugh, right? That's all you got to do. Anyway, but a pretty big deal signed. Even, it's good for our country, right? I mean, it seems like this was our biggest threat going in, according to both parties. And now it looks like we're taking this threat off the table. So looks like, right? Again, I don't want to get political. I don't care who did the deal or whatever, but it looks like this is a fantastic deal. Again, it's about safety, and it looks like a lot of this risk, which was just a big risk, right, for years, North Korea, is kind of off the table. Again, a lot could happen after this. We'll see what happens, but overall, positive. Both sides are kind of agreeing on this, trying to pick on it, but whatever. Big news. Today, the Fed's gonna raise rates. I'm doing this a little bit earlier than the meeting is going to come out. What is it, 2:30-ish, 3, whatever time they come out these days? It's early Wednesday. But they're probably going to raise by 25 basis points. The time you listen to this, if they don't, but they will. That'll be 25 basis points. But more important, it's not just that. That's expected. The market's anticipating it. It's going to be the commentary after that you really have to pay attention to, where the Fed plans on continuing to raise rates or slow down a bit and say, hey, you know what, we're going to wait and see. So the market is getting hot right now, right? Again, continue hitting new highs. It's a lot of inflation out there, definitely higher. You're seeing that inflation, right? And once inflation, it's like a train coming downhill. Once it starts, it's hard to stop, and it's picking up. So let's see how the Fed reacts. Are they going to be like, no, we definitely need to raise rate, or slow it down? Whatever. Let's see. It's going to have big implications. Not the 25 basis point hike, right? It's anticipated that everybody knows that's going to happen. It's the next one that's going to be interesting, because they lowered, if you look at the Fed, especially on the recent risks that have been going on, right? If you look at tariffs and just geopolitical uncertainties and things like that, it's, you look at the market, the Fed is actually anticipating, I think, a 60, 70% chance of them raising. Those are the odds. Again, they keep track of this stuff. They have odds of the Fed rate hike. Futures markets, and it went down to the single digits a few weeks ago. So this is going to change. We're going to see what the Fed's going to. It is going to be big news, right? Again, it's the commentary that's important, guys. So pay attention. I'll cover that next week. Also in the news, International House of Pancakes. They're changing the acronym from IHOP to IHOB with a B, which stands for International House of Burgers. Since the restaurant chain has seen its sales fall for 10 straight quarters, and they need something major, revolutionary, out-of-the-box thinking. We need to change the perception here. It's huge. So they decide to sell hamburgers, like the 20 million other fast food restaurants in the world. Not too sure who's part of that marketing team, if that's the best idea you can come up with. Maybe they should have just launched a marketing campaign highlighting how you're one of the only companies to serve breakfast all day, which McDonald's did. After they announced that, and how big was that for McDonald's, right? Really changed perception of that company when it was down in dumps 3 years ago. I think they announced that. And McDonald's didn't have to change any letters in their name. But for some reason, that's top story. And again, they're only changing that for a little while and going to go back with it. But they want to serve lunch, whatever. Just think it could have been something a little different. But the biggest story of the week, guys, by far, is AT&T. The courts approved AT&T's $85 billion takeover of Time Warner with zero restrictions. Should not be a surprise to anyone listening to this podcast. It's all political. That deal had to go through. The Justice Department had zero case. It's a vertical platform merging with a horizontal one, or a content distributor with tons of competitors in their industry, merging with a content provider with tons of competitors in their industry. No way this even should have made it to the courts. But the courts did deny this deal. Again, basically a merger between two companies in two different industries. You would basically have no mega mergers going forward. I mean, it's insane. When you look at the grounds what they were coming at the Justice Department. Is this going to be better for the consumer? Is it not? It's two totally different companies, different industries. And not only that, I mean, imagine, forget about what's on the table. Comcast, Fox, right? That would have been off the table. CBS, Viacom, off the table. Disney, 21st Century Fox, off the table. Again, that's just the media. Look at the big deals in healthcare, energy, technology. Keep going, sector after sector after sector. Would have been crazy. And we're going from what they provided, right? They provide the roadmap for what companies to really base off of, right? That's court's all about. You cite past cases of what happened, past cases. When you go up there, based on this case, this is what happened. Based on this case, this is what happened, and you prove your point in a court of law. Well, how do you prove Comcast, NBC, Universal, and then come back and say, hey, you know what? We're not going to prove AT&T and Time Warner. That's insane. And what's going to happen afterwards? Can't reverse that deal. You're doing two different things. So this was definitely going to get done. It just, unfortunately, it's our system, it's political, it's lawyers, and maybe some of these guys need to generate some more money, and they did. Like going to court, and AT&T, I think it cost everybody like $1 billion or something like that in total cost to push this out. This deal was announced when? In 2016? Finally got approved? But now let's look at this deal and the implications. Since 99% of the people talking about this deal that I see on TV and the media know nothing about this deal. They know nothing, okay? I don't want to sound like criminal. They know nothing. No, not going to have one of those moments. No, I'm not some genius. I'm not some brilliant person. I consider myself a good analyst. I've been doing this for a very long time, and I follow these companies for a very, very long time. AT&T is one of the biggest holdings in my portfolio, okay? And I want to share my take with you, since it's original. Because this deal could result in AT&T becoming one of the biggest companies in the world in just 5 years from now. Forget about what you're seeing with the stock price today. Yes, it's going to go down. Maybe it goes down even further. Maybe it goes down to 30 over the next couple of weeks. I don't care. Doesn't matter. Don't look short term. Hear me out first before you think I'm crazy. Because I know there's people out there, newsletters, talking about their debt, they're going broke, so avoid AT&T is terrible. That's why this is different. Just hear me out. Even if you're on that side, it's good to hear this opinion. So before you shut the podcast off, just listen. Because I'm going to throw facts at you, which is important that you look at the facts, not opinion, not stupid headlines. So Time Warner, if you didn't know, one of the biggest and best content providers in the world. It's about HBO, Cinemax, TNT, which is, basketball, huge for TNT, right? And Turner Sports Network, along with DirecTV now with the NFL package, so a massive sports presence. These combined companies, but sticking with Time Warner. You have TBS, Cartoon Network, 10% ownership in Hulu, CNN. You have Warner Brothers Entertainment, which is the movie studio, where 17 years in a row, its movie division passed the $1 billion mark, both domestic and international. They're in a fantastic business. They have more than 8,300 movie titles, 10 of which were Academy Awards for Best Picture. More than 5,000 television programs. So a massive, massive content provider. Now, Time Warner and Turner have a massive inventory of advertising that amounts to more than 750 billion impressions per year. Impressions, important word, right? That's an ad that's viewed by someone. This is how advertising industry charges its customers based on impressions. 1,000 impressions is how much it costs, whether it's $1, $5 for offline, $1.50 for online, whatever it is, right? So it's impressions. Now you combine that with DirecTV and AT&T's network, which get over 200 billion impressions every year, and you just combine a company that has over 1 trillion impressions per year. You're talking about tens of billions of dollars in advertising revenue from a company, AT&T, whose business model right now has nothing to do with advertising. What do we know about advertising? Look at the stocks of Google. Look at the stocks of Facebook. Look at these stocks that do fantastic. Advertising is an amazing model. Online, mobile, amazing model. Secular growth, massive growth. You talk about a company that's going to be in the same league as Facebook and Google. But, and there's a big but here. It's not going to happen right away, but it is going to happen. It's not just about advertising. AT&T has 160 million wireless subscribers. They can send ads to those people whenever they want. Now they have massive content. Again, I'm in the content business as well. It's important. The reason why our business works is because we have great content. That's something I'm very proud of with Curzio Research. We have a list that's 1/1000th the size of our competitors, and we're able to generate a lot of money. Why? Because we have great content. Because we have great analysts, guys out there. You're going to see them on TV. They're in the field. Content is key. Time Warner is one of the greatest content providers in the world. They have great content that people want to see. Okay, very important to know. So you're looking at DirecTV, part of AT&T. In 20 million homes, they can send ads to these people directly. So you have the DirecTV, 20 million homes, AT&T, 160 million wireless subscribers, 20 million connected cars are on the AT&T network. That number goes higher every month. So you're basically talking about an advertising giant. And sticking with Time Warner still, take a look at the profits for Time Warner over the past 10 years. They've gone up every single year. They project to go well over $6 billion this year. Profits, $6 billion profit, not revenue. Over the past 7 years, the company has a compound annual growth rate of more than 17% over the past 7 years. That's higher than Disney, 21st Century Fox, CBS, almost every one of its competitors. Their core competitors, I couldn't find one higher. Now, the key to this, throw in what Facebook is doing, what Google is doing, big data analytics and cloud. AT&T is going to know everything about everyone. Yes, there's privacy issues. Yes, we have laws coming down. Yes, we understand. We're seeing what's going on with Facebook right now. But they're going to be an advertiser's dream. They're going to know what's going on. They're in these people's homes. They're in mobile. And you talk about 150, 200 million people strong in the U.S. who are some way or another on AT&T's platform. These guys have direct access to their lives. Again, they're going to have their mobile phone on them and their homes. Now, throw in one of the biggest technology trends in the world that really nobody's talking about, that Steve Kumar mentioned, I mentioned last week, 5G. 5G makes every single major trend in technology that times better. Cloud, big data, AI, all this stuff. 5G is huge. What is 5G? It's basically speed. It's going to increase the speeds. Think how fast everything is now when you stream. Again, like 7-8 years ago, it was tough to stream a movie on Netflix. Now it's not a problem. You could download. Everything is media. Everything is commercials, right? Every site. Everything is a video now. Right? I mean, 6-7 years ago, even some of the mobile phones, you couldn't really watch video. You didn't have the capacity. It was slow. Now it's like 1 second. Think about how fast we are now. 5G increases our speeds by 50 to 100 times. That might not mean a big deal to you because you're used to watching movies, but think about algorithms. Think about determining what people are doing, predictive analysis, AI. This puts it to another level. And the companies who have the most exposure to people are going to learn the most about them. That's where we're going. Forget about the privacy issues. Forget about everything else. I know that's a whole other topic. But this is why on Facebook or on Google, if you're looking at something, it seems like even if you're talking to your wife about something and you go on Google, next thing you know, there's an ad for like a vacuum cleaner that you talked about. You're like, what the hell's going on? This is AT&T. They're going to have access to what everyone's doing, and they're going to send you ads tailored to your needs. It's not going to be like these, you watch TV and you see all these ads that you don't care about. No, they're going to be sending you ads that you do care about, of products that you buy. They're going to have all this analysis through big data and cloud. So you're looking at this deal, it's creating one of the biggest media giants in the world. And they're going to have significant advantages over Facebook and Google, since these companies are what? Internet-only advertising businesses, right? You generate sales from advertising. That's the bulk of their revenue. Then you look at Disney, Comcast, 21st Century Fox, Viacom. Yes, big in advertising, little access to mobile. Now, look what AT&T has. They're going to be generating billions in advertising, billions from mobile, billions from pay TV, and billions from internet. They're rolling out fiber everywhere. I mean, this model basically puts Comcast out of business because AT&T is going to have much better content, much faster internet speeds, which I have already, better card packages to stream content. And seriously, when you look at Comcast, why would anyone need to have a subscription to Comcast? I mean, it's a company that signs you up. And again, I'm not getting personally, I don't like Comcast, but, they force you to get triple play to pad their numbers. I mean, all I need is an internet connection. They're like, well, for the internet connection, it's going to be $800. But if you get the triple play, it's going to be $250. I'm like, so basically I'm paying for a phone. And then after 2 years, it's going to reset. This way, you're going to pay a ton of money anyway on internet, and I'm still paying a ton of money on on things that I don't use. Whether it's I'm not using your TV or I'm not using your phone, that's the business model. And a company that, again, this isn't me ranting on them already. I had that rant already, but if you look at the statistics, look at the top 20 companies that the worst companies when it comes to customer service, they don't need to care because it was a monopoly. Well, now you're getting threatened. Because that monopoly was built on you having great internet, and now AT&T is rolling out fiber everywhere. They can offer TV through DirecTV. They have wireless, so you could have your it's like a complete massive package that you could order under one umbrella. Now, the big headline, what you're waiting for me to get for, is the debt. AT&T has the biggest debt load out of any company in the world. It's insane. They're going to go out of business. Guys, just do a little homework here, because the people that are saying this, it's just insane. I'm going to put this again. I'm throwing facts at you. You could come up with your opinion. You could say, Frank, you're a moron. I hate you. AT&T is a joke. Your analysis is terrible. Fine. These are facts. Okay. AT&T is going to have about $175 billion in long-term debt, a massive number, and the highest by any company in the industry. Makes for a great headline. I'm hearing the company's going to go bankrupt. They're going to be in trouble. This is crazy. Better watch out. But for those of you who believe AT&T's debt is an issue, okay, just go back to July 27, 2017. So in 2016, they announced this deal, so they needed to raise money. So AT&T went to the bond market. They raised $22.5 billion, right, the bond market. Like the third largest investment-grade bond offering, I think, in history. Again, I have great bond analysts that are listening, so again, I'm pulling these stats up, and they're going to correct me if I'm wrong, but that's basically what's been reported. This was raised for the Time Warner acquisition, again, which was announced 2016. The longest portion of this sale, which came in 7 parts, this deal, is a 41-year bond that yields just 2.5% more than treasuries. That's it. And the market was begging for AT&T to do more. The original offer was $15 billion, and they raised it to $22.5 billion. They had enough orders to go to $65 billion. Okay, those guys are usually pretty smart, guys in the bond market, right? A lot smarter than the guys in the equity market. They were dying for more, right? For a company that everyone's worried about is going to go out of business because their debt's crazy, right? They're going to get some more figures. Okay, so they just settled and said, AT&T said, no, we're going to do $22.5 billion. That's fine. They could have did over $60 billion in an offer. They raised that money. They had enough cash. That's it. Now they're going into this deal and the Justice Department and everything else. Now, looking at the facts, AT&T is going to have $175 billion in long-term debt. Only $70 billion of this, I say only, which is kind of crazy, only $70 billion is going to be due over the next 5 years. Now, the company right now has close to $50 billion in cash short-term investments on its balance sheet, but they're going to use some of that to actually pay for the transaction for Time Warner. They're expected, which they're doing right now, they're doing, without Time Warner, $20 billion in annual free cash flow. They're going to do that for the foreseeable future, right? That's easily enough to cover their debt. They're not going to use the entire cash position to put in. It's half cash, half stock transaction, right? So maybe they keep $10 billion, $15 billion on the balance sheet. They're not going to have debt concerns. Right now, without Time Warner, $20 billion in free cash flow, right? We just talked about the bonds and how they could have they saw more demand against demand. So if you're looking at debt, right, again, these are some facts. AT&T doesn't have any debt concerns. Is it the highest amount? Yes. We're talking about a company that generates over $150 billion in sales every year. I mean, it's insane. And again, we're not even talking about all the synergies and everything coming in and all these businesses and everything that they're going to do. So if you're looking at their debt over the next 5 years at $70 billion, and you just take the number of $20 billion free cash flow, which nobody's talking about, right? Not to mention they're going to have at least $10 billion, maybe $15 billion in cash on their balance sheets already. I would talk about not a problem at all of paying this debt off. Not only that, if we look at it, right, after, this is post, based on my analysis, post, right? Because people are like, well, how are they going to pay the dividend? The dividend's crazy. If you look at their dividend, right, they're going to pay it for the foreseeable future. You might say, wow, that's crazy, but I had these debt concerns, and I thought they were going out of business. And people say, if you look at right now, right, even right now, their dividend payout ratio is 60%. Post this deal, it's going to be a little lower. It's probably going to be like 55%, the dividend payout ratio. What does that mean? It means dividend payout is, if it's 100%, that means they're paying out their last 12 months of earnings goes 100% of that is going to their dividend. So if you get 100% or even 80%, that's really high. Goes over 100%, it can't be sustained, right? So you want a lower dividend payout ratio in the 50s, 60s, 40s, 30s means that dividend is pretty safe, right? They're covering it easily with earnings, right? Easily with earnings. Let me give you a couple examples here. Chevron, again, I told you AT&T is going to have lower than a 60% dividend payout ratio after this deal's done. Chevron has a dividend payout ratio of 80%. IBM has a dividend payout ratio of 90%. Caterpillar is well over 100%. Kind of crazy. Again, meaning its dividend payout is higher than its earnings that they generated over the past 12 months. Doesn't mean they're going to have to suspend the dividend, generate cash flow. Maybe it's a year. They took right down, whatever. Even McDonald's dividend payout ratio is over 60%. It's going to be higher than AT&T. I don't hear anyone saying McDonald's not going to be able to pay the dividend. They're in trouble. It's crazy. You don't hear that. That's not the story here. So people are worried about debt with this deal when you're merging two huge, great companies. So when I look at it, no. Debt concerns, not worrying me. It's not worrying the market either. Maybe they get a couple of tiny downgrades, still investment grade. But more important, you're looking at a boring company that's just added a massive growth component, which is the top driver of some of the biggest stocks in the world, the FANG stocks. It's advertising. And you look from a valuation standpoint and say, well, where is this stock going to be trading? I mean, AT&T is at 10 times 2018 earnings. Now, let's put that in perspective. 10 times. It's a 40% discount to the S&P 500 right now. It's also the cheapest valuation AT&T has traded for in close to 20 years, going back 20 years right now. So that's how concerned people are with this Time Warner deal, and it's crazy. Holy cow, it's not going to work out. I mean, you look at AT&T, look at the big picture, guys, right? You have to commend them for doing this. What's the other option for AT&T? Well, let me be leveraged to wireless, which is a dead market. I mean, how many people do you know need a phone in America? Nobody. How many times you put on a commercial? Oh, if you buy this, you get one phone for free. You get this for free. You get that. Oh, it's only $30 a month now, $40. Family plans, this and that. You see them constantly, no matter what show you're watching. It's a highly competitive market with zero growth, which is what Verizon's really leveraged to right now. AT&T said, no. We saw this coming. So you know what? We bought DirecTV. And now we're going to buy Time Warner. And we're going to be into nearly 200 million homes in America, analyzing big data analytics, cloud, all this stuff. Becoming like a Facebook now, becoming a Google now, a massive growth model, right? Online, mobile, right? Huge in mobile, huge in TV, right? They're going to have access to all these customers no matter what they're doing. Not just by going on the internet, not just going on the phone, being in their house, watching TV, streaming, internet use, all these different revenue streams coming in. Pretty amazing when you think about it, when you put it into that context. Because 10 years from now, I really believe they're going to look at this deal the same way as they looked at Exxon buying Mobil in 1998. And 10 years, what were they thinking when that happened? And holy cow, we just created a massive powerhouse. That's what I really believe we're going to see here with AT&T. And AT&T will become one of the biggest companies in the world again. They're in a huge market that people pay a premium in. They just went from a very, very slow growth model to something that's driving Facebook, Netflix, and all these guys. And they have significant advantages over these companies because they're also attached to mobile. They have different areas that they're going to be generating revenue. They're not 100% leveraged to one particular industry. And that's where the world is turning. Big data analytics, cloud, monitoring people, putting the right ads in front of them. 1 trillion impressions a year. Things people aren't talking about when it comes to AT&T. Yes, the stock's going to be down. They just took over a big thing, paid what, $85 billion, right? Including debt and everything, it's $100 billion. Yes, their debt levels is going to go up, but when you look at it and you're seeing the massive cash that they already generate without Time Warner, 20 to 22 billion in free cash flow. If you look at the debt, it doesn't look so concerning anymore. And again, the bond market's going to tell us, yes, you might see a little bit of fuel downgrades, people worrying. But man, if this stock goes lower, I'd use that opportunity to buy shares into one of the biggest stocks in my portfolio. I love it. But I love what AT&T is doing here. Becoming the largest company in the world. Again, that's what they're looking to do. Okay, buying DirecTV, Time Warner, getting to advertising and content industry since, going to become the largest distributor of content in the media world. And I look at that and I think it's unbelievable and fantastic. It reminds me of Square. I don't know if you saw the movement in Square. It's one of the stocks we have in our portfolio. Square used to process through First Data, which was the biggest in the industry in credit card processing. If you look at their market caps, Square is about $6-7 billion now, maybe even more. They're bigger than First Data. So what do? They do their own processing now. They don't need First Data. If you're looking at AT&T, getting into the advertising, getting into these different industries, now they're the ones that are combining all this stuff together, trying to become the ultimate powerhouse in media. And this deal is going to make that happen. That's my take. Again, original. Nobody loves AT&T. Everybody thinks it's terrible. It's going to go out of business. I've read pieces on it. I haven't heard anybody talk highly of AT&T yet anywhere. But again, it's the largest company in my portfolio. So if I'm wrong, I'm probably going to feel it the most. Now, let's move on because I have a great interview set up with my buddy Andrew Horowitz, who has the third best financial podcast in the world, behind me and Mike Alcon. Horowitz is the host of the Disciplined Investor podcast and also manages my interest investment firm Horowitz and Company. So Andrew and I are going to break down a lot of different things. Like we get the Fed decision today, and we do this podcast again a little bit early. We can talk about that and what implications it has. Again, the commentary after is going to be very, very important. And Andrew does a great job, looking at these numbers and analyzing stuff, and for his trading platforms and everything. He's going to talk about the international implications of higher interest rates, why you need to be careful as an individual investor. And like he always does, he's going to share his favorite trading ideas with you. One company I'm sure that you've never heard of before, that's a trade because of something that's going to happen over the next 3 to 4 months. So you know what? Let's get to that interview right now. Andrew Horowitz, thanks so much for coming back on the podcast, bud.
Of course. Appreciate it. Thanks for paying me to be here.
I paid you a ton of money, man. How much was it?
It was more in compliments.
Yeah, I paid you in, I was going to say Bitcoin, but Bitcoin's coming down a little bit. We'll talk about crypto a little bit later, but a lot of stuff, right? A lot of news going on. We're doing this early, guys. It's just Wednesday, and by the time you're going to listen to this later today, the Fed's going to probably announce a 25 basis point hike, which is not the big deal, right? But the big deal is always a commentary, and you always great at that, where we talk offline a lot, Andrew, about the commentary and the Fed and what they're saying compared to last quarter. What are your thoughts on what the commentary is going to be? Because that's what's going to drive the market, right? Whether they're going to have a wait and see approach or whether they're going to be more aggressive. And, it's kind of up in the air, right? People are like, okay, enough, you can slow down. But, there's a lot of, it's definitely going to be market moving based on what they're going to talk about.
Yeah. First of all, what everybody's been talking about right now is this whole idea. You see it all over. It's baked in that they're going to be raising by 25. It's baked in this quarter. We know it's going to happen. So, if the market's already pricing it at 100% probability that there's going to be a rate hike, the Fed would probably be unwise to do anything other than follow along, because it would be essentially deemed a surprise. And they don't like to spook markets and surprise markets. And then anybody like, well, why aren't they raising? What's happening? So yeah, I agree that this 25 basis point hike is definitely in line. And of course, we have still what I would say to be emergency level interest rates and where we are in Fed funds. And the thing is that what they're, I think, going to talk about in the follow-up when Powell has his press conference, the presser, is that they're going to leave it a little bit open, because they're not going to want to be, I think, as hawkish, even though clearly the CPI, the inflation rate that came out this week, was at 0.2%. However, if you look at it, the compounded level of inflation is at a 6-year high. So that's kind of important, that inflation level is hitting that 2% level. Unemployment's at 3.8%. That's important because it's obviously close to a full employment situation. And if you want to rip it down and talk about the labor participation rate and a few other things, okay, you can make an argument that, where there's some slack in the labor markets. But generally speaking, all things are good right now. And we're still at emergency levels. So I think the Fed, though, is a little bit concerned because we have two things that are fighting and are problematic. So we're in a time period right now where the economy is good, and it has been good. And at the same time, not only do we have stimulus on a monetary basis from the Fed, but at the same time, we have stimulus on a fiscal basis by tax cuts. And while we're starting to see some of the benefits from companies and in markets and lower taxes, and possibly that's why some areas of the markets are getting a much better opportunity and giving them the benefit of the doubt, aka retail. I think the Fed is also going to be saying, okay, we want to be raising rates into the future and be hawkish on that side. On the other side, you have, but at the same time, we're starting to really remove liquidity from the markets, and that's really impacting a lot of areas around the world, in particular the emerging markets, who are putting up a white flag and begging the Fed to be careful how much they raise as the dollar goes up. And at the same time, we're seeing things like commodity prices going up. That's very hard on them. And their economies are having big problems. There's strikes in Bosnia, trucking strikes. There's a discussion in France. There's going to be a trucker strike. Basically, Brazil was shut down. Their economy's in a recession. We saw a massive amount of slowdown because about 64% of all of the transportation of goods in Brazil is done by truckers. And there was a blockade. They shut it down. So we're seeing big problems there. Their currency getting obliterated. And these emerging markets, they're kind of levered to the US dollar. They're levered to the US economy. So while the economy is good on one hand, it's really showing up in relation to their currency and their ability to buy things and to get things done. They're having a lot of problems. So it's a very fine line that the Fed's going to have to run. I think they're going to tilt a little bit towards the more hawkish side of things, but not entirely hawkish. They're not going to be like, yes, we're definitely going to be increasing another time by the end of the year. We have 2 more meetings that we could potentially look to do it, September and December. I think they're going to follow the same game plan as last year and just hit one up more in December. So, but long-winded answer to your question, but there's a lot of things and a lot of moving parts in all of this, and they have to really thread this needle pretty well to make sure the world stays balanced, because now you're starting to see discussion of contagion in the emerging markets, and this whole problem of what's happening in Brazil and Venezuela and Argentina, and there's pockets of areas that are good, that are aligned more so with China, but starting to see banks in Europe have problems, and this is all about a liquidity crunch. So very fine line.
Now, you brought up a lot of interesting points. I guess I'm going to ask you, how relevant is weakness? I'm not talking about weakness in Bosnia and some of the places you mentioned in Brazil, but how important is that to U.S. investors, the individual investor? Because we're seeing our country thrive. We're also seeing where people are complaining about the latest actions on tariffs, but these companies are robbing us, and we're definitely in the driver's seat to the point where these guys need to do something, or they're going to weaken their economies further, and a lot of them are on shaky ground compared to ours. So as an individual investor, and even like yourself, are you concerned where that could hurt the U.S. market if we continue to raise rates a little more aggressive, where I agree with you, it's going to hurt the international markets? And yes, we know whatever it is, 35% of profits come from the S&P 500 or from overseas. Is this going to be a big impact to the market, to stocks that you think, or is it again, people here international and why should we care, right? I'm just saying that. I'm saying some people would say that. What are your thoughts on that?
I think that if we are in I think it's 2 answers. So look at what's going on with the small cap market. All-time highs, hit an all-time high before the large cap markets re-hit that again. That's telling the story that U.S.-centric, domestically based companies that don't derive a lot of their income and revenue and earnings and even products, manufacturing from overseas are doing much better, or at least investor sentiment is much better with them. At the same time, yes, we're seeing some of the mega caps, but these are internet related, and Apple and all those names do very well also. So I think there is a potential for some of the multinationals to have much greater headwinds from the dollar rising. We saw a lot of tailwinds for a while there. Then the headwinds from the dollar rising recently, and from the tightening, they still have a lot of money in the bank. many of these companies, so it's not a problem. But I do think that if we are going to be living in a globalized, I guess a trade that's globalized, it could be a big problem if you have trade tariffs because prices just go up. Look what happened with aluminum. Look what happened with lumber. Do you see lumber prices hit an all-time high like a month ago?
Yep.
And what does that do? Well, just to let everybody know, your housing prices will go up. Or if you contracted for your house, a new house that is, and they're using wood in the construction, what's happening is that the builder can't increase rates on your house that you're already contracted for. That's why you're seeing such a rough patch for many of the big builders. They're having input price problems. So this whole thing of, of tariffs on, tariffs off, U.S. is so great, the rest of the world stinks. We need to, beat up on all these companies. I don't know. It seems to me that we want everybody thriving. And if we're such a rich country, for those people, by the way, that are like, USA first, which is good, and, screw the rest of the world because look at how much they're just getting off our backs. I have a question. Have you traveled? Have you traveled to areas throughout China, through Asia, through Latin America? Listen, they don't have it so good. A lot of places don't have running water. They don't have toilets. You're like, who cares? Well, you know what? It's not like everybody's living like we're living here in the United States as a baseline, and they're just stealing from us even more. No, we have a lot. So there's something about, there's something in Judaism we call tikkun olam. And it's repairing the world, making the world a good place, not for the fact of just helping out and being charitable for other people too, but because it's good for everybody. It's just good for everybody. So if you have everywhere around the world thriving, that's good for us. That's good for our companies. That's good for the technology. That's good for sales. That's good for just everybody in total. So if they're taking a little bit extra from us and they're still having, to live in the summertime without air conditioning because they don't have that technology or the ability to pay for that. All right, you know what? So maybe one day they will. And where are they going to end up buying the air conditioners from potentially? Well, it could be from their own company, but it could also be from our multinationals. So, I mean, it's kind of like go back and forth with this whole idea of, let's put up all these trade barriers. Let's, these companies and countries that have been stealing from us all these years. It's not like, all these years there's been such a big problem here in the United States. We just want more now. We're on this thing that we want more. Let's get more. Let's get more. But at the same time, can we get more? Here's the question I ask. Can we get more if in fact we're taxing the other guys that are providing some of our base? Again, it's a very fine line that we're walking here. Very, it's an experiment that hasn't been tested very well. And in history, the only time we've seen tariffs back in Smoot-Hawley and all that didn't do very well. Depression was kind of the end result of it.
Yeah, it's interesting because, you bring up a good point about international, just to get off topic a little bit. But even what we did is, what my family is, because I travel all over the world as well, as you do, Andrew. And I have like an international, timeshare, right? So I make sure it's international where we travel a lot. And so I get the kids, because I didn't have that when I was younger. It's just my family didn't, travel too much. And when you really see, I want my kids to see what's out there, to see how great you have it. Because now when you listen to people, I complain about traffic, and they complain about, not enough TV programs on. My phone's a little bit slow. I'm like, these guys, some people don't have access to water. They don't have, like, people in our country don't realize how amazing this country really is. And when I see people just, I don't care what political party you're from, and just rag on it, move, get at it, go someplace else. You go wherever you want, you want. But the benefits that you have are unbelievable if you've been out there. And I want my kids to understand that.
How pissed off is it when you go to your phone, you're trying to get something downloaded from the internet, you're like, God darn it, I only have 4G. Oh, man, that sucks. Like, I mean, honestly, you go around the world in some other places, they're still working on maybe 3G, maybe 2G, maybe not even any data carrying across a cell phone to begin with. So there's areas around the world, we do have it really good here. And I know that we want to have it better for not only for this generation, but for generations to come. And I don't think of myself as necessarily a globalist. I don't think of myself as a protectionist. But I do think of myself as someone who, let's be smart about how we go about all this, and let's figure out how it's, the balance that would be good for everybody. Clearly, the initiating parties. So if the iPhone, for example, use this as a good example, the iPhone was developed here. It is by a company here, but yet at the same time, and driving the revenues and jobs and all that, but we have jobs somewhere else too because of it. Spread the wealth around a little bit, and it helps out everybody. If we didn't have iPhones in China or in Asia, Apple would look like a much different company, wouldn't it?
No, absolutely.
Yeah, spread the wealth a little bit. It's okay. It's okay.
Model.
You know, spread the seed a little bit. Spread a little fertilizer around. It's good for all the people.
So you're gonna spread because I know you go fishing all the time on your boat. Are you gonna spread the wealth around and take me fishing one of these days or what?
Yeah, of course. Either that, I'll send you a bunch of fish. We had a great party this weekend, a crawfish party in my backyard. 80 pounds of crawfish we brought in.
And are you going to Bahamas or something? Or
I'm going this weekend I'm going taking the boat up to the West End Bahamas. Do a little fishing up there, a little snorkeling, conch, get some spiny lobster.
How many miles is that? What is it?
70. It's 70 miles.
It's check the weather and everything. Isn't it like the
weather's good.
Triangle and stuff? What do you?
No, I'm not going through the Bermuda Triangle. No. But I'll give you some pictures when we come back. The water's just beautifully clear, gin clear water. It's funny. The guy's house who we're staying at, we're kind of like an Airbnb. There's like one. So it's like, listen, we know it's tough to get stuff. Is there anything we can bring you over? He says, as a matter of fact, I'll send you a list. So he sent us, he wants brake pads. He wants fan belts for his car, 20 pounds of ribs, 60 pounds of chicken. He wants like 2 cases of Diet Cokes, 2 cases of Coke. We're like, whoa. We thought maybe you wanted, I don't know, some Q-tips or something. You know?
Hey, you asked.
I did.
Great. No, we'll be safe on that trip. 70 miles. Yeah, that should be fun. But I want to get to a couple sectors here that you've been talking about. One of them is retail. There's, big box retailers have been on fire. They've been doing well. Even the worst has been popping up. JCPenney from its lows up about 20-25% now after the CEO left. But if you're looking at Macy's, you're looking at Kohl's, a lot of these guys are making really good moves and big moves off of their super depressed lows in what was it, October. What are your thoughts on this industry? We're seeing retail sales pretty strong and people spending money like everybody has it, right? What are your thoughts about this? Is this trade, over, done with? Should you get out of it? What are your thoughts?
Well, first of all, I'll give you compliments back in October. I think it was October, maybe November, whenever the low area was, or right before, right after. It was right in that period. You were on my show, the Disciplined Investor podcast, and you said, get into big box retail. And I'm like, really? But you definitely called it right. I'll be honest. Now, I think what they're doing is better inventory, generally speaking. This is a general comment, not individual stores, but the big box retailers. The malls are still dead. They're drying up. They're shriveling like a bad raisin, okay? You look at the traffic in the stores, even anecdotally when you go in, I mean, it's not a lot of foot traffic going on. Yes, they're getting better with their online. They're getting better with their inventory management. They're getting better with not having to mark down stuff because they have better inventory management. It's not necessarily because people are just buying stuff like crazy just off the shelves. But the worst was, these guys are going bankrupt. And I think they were being sold off with that in mind. That's where sentiment was. Now, I think sentiment has shifted the other side. Like, you know what? It's not as bad. The whole Amazon impact and the effect of Amazon is not as bad. And people are actually going back shopping because they have more money in their paychecks as their taxes are lower, so they're spending. And we saw the retail sales recently look a little better. It's a noisy read, the retail number, and we don't know where we're going to have it. We have to look at it over a several-month period, but okay, it definitely looks better, and that does make sense. More people are working, so more people have to buy things. That makes sense also. I still am questioning whether or not things like, Sears is closing up another 72 stores. There is just so far these stores will go until they got to either cut expenses dramatically, and hopefully that will help their bottom line and maybe, do better. But I just think some of these are a little bit overextended right now from, really where they should be. I think the sentiment has shifted too hard to the other side with the thought that, wow, there's going to be a miracle here. The miracle is not there. This is kind of like what happened with Radio Shack. I mean, you don't need to do Radio Shack. They went bankrupt. You don't need to go to a Sears and buy tires anymore because you can find a tire app that will have them delivered to your office or your house, and they'll put it on in the back. There's tools that you can get somewhere else. And as this next generation, and forget about our generation that's buying, this next generation, they don't look up from their phones. They're going to be buying everything. I tell everybody, it's like Christmas in my office every day. I get boxes every single day of delivery of goods because I don't want to get up out of my chair. I'm working, I'm doing my thing. I'm clicking buttons at the same time, buying things. The next generation is going to be even more inclined to buy things online, and as the ability to do so gets easier and easier. And look at Walmart's having trouble keeping with their margins. You saw the dollar stores lately just last week, the earnings came out for Dollar General and for Dollar Tree, and they just got obliterated. Five Below did very good. That's actually, we own that stock in our portfolios. It's kind of, people are opting maybe because the dollar stores really don't have things for $1, and a bit of a beta switch process there. But I don't know about you. I go to the dollar store. I'm like, how come this is $2.50? I thought it was supposed to be $1. I don't understand.
It's so fun. Like the business model just eventually is going to come back and bite you in the ass. You know, it's,
right.
If you have a business model that you have you cannot like even with a low cost airline, there's no such thing, right? JetBlue is a low cost airline. Their prices are just like everybody else. Basically, so if oil prices go up or your costs go up, you're going to keep those low costs. You're going to have to raise. If you're limiting the amount or the price that you're going to sell something, it's not a good business model. Eventually, you're going to have to change it, and they are. It says dollar stores, but like you're right, there's nothing, barely anything in there for $1 anymore. They have to raise prices.
Right.
They have no choice.
They need to make it. If you calculate the inflation rate over the last few years, it has to be like the $1.26 store. Something like that.
Yeah, that's just inflation from when? From just not too long ago.
I want to mention something though, because before we skip on to this, because I think there's something really important here. I think there's two things that are really happening in the economy right now that nobody's really talking about very much. I think the first part of it is, yes, I agree with the retail sales. People get giddy, they get some more money, and what do? They spend it. They save it and they spend it. There's something else also that's happening that or at least I believe that could be happening, and it's a pull forward effect. The pull forward effect. So if you remember a few years ago, Japan had a massive increase in their sales tax. Remember this? And they put this because they had to do so because they had so many bonds outstanding from the quantitative easing program that they did, that basically the rating services were going to say, we're going to have to downgrade the sovereign here because you don't have any income to pay for this. The country's doing okay, and you're still kind of in a deflationary spiral, and you're pretty much at full employment here and all. But at the same time, you keep on buying bonds, and then there's going to be the requirement to do the debt servicing and pay it back. And where are you getting the money from? Well, they didn't want to really necessarily raise taxes or maybe do something, cut anything, God forbid. So what do? They decided on a sales tax increase. Now they set the date. Date's going to be February 22nd or whatever exactly the date was. There's going to be the sales tax. And what did everybody do? They went out like crazy people and stocked up on everything they could beforehand. And what do you know? Right after that, sales dried up and they went into a recession. That's exactly what happened, okay? They tried to do it again, and they said, well, maybe we should think of a better way to do this. But here's what my point is. There's a pull forward process that happens sometimes when there is something that is on the horizon that may change the way that business is done, or possibly the way that the cost factors involved. With tariffs and the threat of tariffs right now, I do wonder if there was a lot of pull forward of buying. And that's why some commodity prices have gone up, even though these tariffs really haven't, steel and aluminum tariffs have been put in place, but there's really no tariffs on like China. There's just a lot of talk and back and forth talk, and there's talk about tariffs here and there. And we have some period of time when the tariffs were exempt from this other ones. And so who knows really what exactly is being tariffed right now. But meanwhile, prices went up on aluminum, prices went up on steel, prices went up on lumber and a variety of other commodities. Oil's a separate department altogether. But I do wonder if the threat of the tariffs was a pull forward effect on people buying things, manufacturing from other countries, from the United States. And therefore, we're seeing a little bump in the economy due to that, that may in fact see the same kind of situation where after the big buy was done, kind of a slowdown ensues. Something to think about.
No, definitely a good point. But I want to change tunes here because I know there was a couple of subjects that you wanted to talk about, including cryptos real quick, where we're seeing, again, Bitcoin's coming down. This is an industry that I'm pretty bullish on over the long term in terms of blockchain, and a lot of different companies doing amazing things in this space. But, I'm for, listen, you got to see regulation in this industry. It's got to get cleaned up this way. There's more confidence. There's more accountability. What are your thoughts? Is, a lot of people still think this is a fad. It's crazy. We just saw a recent hack, which is pushing prices down a little bit over the past week. So, what are your thoughts about?
You should say a little bit.
Yeah, well, I mean, people forget really, because people are quick to say that Bitcoin's down 50% now from its highs, but in the beginning of 2017, it was like 1,700, and it's still 6,000, over 6,000. So, when you take into consideration like the whole package, even the year and how much, it's just when you can't. I mean, people say this is an actual currency. Again, you see the fluctuations of the currency, which is crazy. But when you take it from where it was 2017 until now, and you're seeing what I'm seeing is the institutions really going into blockchain technology and spending a lot of money in this sector and taking it for real. What are your thoughts on this? Is this just something that's going to go away? Is this just something that you're totally negative on, or do you see it, as a good trade? Maybe you like Bitcoin, Ethereum, or something.
So I think there is some validity to there's two parts of this discussion. So there's the coin discussion, cryptocurrency coin discussion, and there's the blockchain discussion. The cryptocurrencies and coins will pretty much run on the blockchain, right? The distributed ledger and how things are moved from place to place or paid for. And then you have the whole ICO thing and all that. I think there is some validity to the storage of value concept, where you have the opportunity to have money outside of the sovereignties and put money into something. It's kind of like an investment, but it's not necessarily under the roof of a particular currency. And that if in fact there's one of those that can have the opportunity and ability to utilize for quick payments internationally, where it clears and it's secure and all that, that's a good thing. I can see that. Some of the other coins, I mean, probably 98% of them are just crap. These white papers that anybody could, I've seen people do this that I know. So they create these white papers, they create all this excitement, the PR machine starts going, and everybody's like, look at the team, and then they got these brilliant guys from India, and this guy from China, and this guy from Japan, a couple of guys from Palo Alto, and oh man, that team's great, we're investing in them. And the coins go up and they go crazy and they skyrocket and they come back down. The blockchain, on the other hand, the blockchain's interesting. It's a technology, it's a process, it's a really cool way of, I guess, doing business, we can call it. And I mean, but do we get that excited? It's kind of like an OS in a way. I mean, if you could think of it that way, it's not an OS, but think of it like an OS, where you have Linux and you have like Microsoft and you have Apple and you have all, different kind of platforms that you could run something on. So the blockchain is where you could run something on. It could be coins, or it could be business, it could be inventory control, it could be shipping, it could be all sorts of things. So I think the blockchain, somebody's going to have to figure out how to, in fact, maybe create a business around blockchain, just like Red Hat did around Linux, right? So Linux was open source and anybody could use it. And what happened is that Red Hat came along and said, you know what, we're going to service it. We're going to help create it. And look what happened to Red Hat. That's a great company, just an amazing company. But what are they doing? They're basically servicing an open source free platform that they took on, and they have Red Hat Linux, but they took on and they actually made a business out of it. So if there's the opportunity for a company to come in and coordinate that and help people with their blockchain for the purpose of whatever their business need is, I think that's great. But I don't think we should confuse it. I recently had on I don't know if you heard this, but I was up in New York and I did a series of interviews at the Benzinga FinTech Awards. And this was last month. And what I did is I made a series of podcasts, mini episodes. One of the guests that we had on, and I think he was playing, I think it's this week he was on, you can just listen to one of the series, is Tom Eck. He's the head of IBM's Watson division for finance and fintech. And we talked about blockchain a little bit. But basically, IBM is trying to get into that also, in the whole financial sector can be theoretically run on it if it's safe. But you have to separate the two. I just think that this whole movement is very interesting in terms of the concept of using it as a currency, where you have a currency moving up and down 5% a day. That is not a currency I want to be involved in. That's a speculative play, and that's fine. You want to invest in it, have at it. You want to use charting, great. There's no fundamentals, so you got to throw that aside. So just use charts, do what you got to do. If you want to trade it, swing it, scalp it, hold it, that's great. But I think there is an opportunity in some of the big names. I think Ethereum is getting just whacked due to the fact that a lot of the other smaller ones are built upon, on top of Ethereum, and sort of seeing some of that problems happen that many of these other companies are kind of getting withered away. I don't know. I can go back and forth on whether it's great or not. I don't know. It's been a great run. I think the value of it seems to be just a lot of speculation and sentiment based investing.
Yeah, it is a pretty crazy industry. And one of the big changes I see is the ICO industry. I've seen some of these white papers where you have kids with no operational experience. They'll write something on a paper napkin and raise $15 million like nothing. and saying this is what we're going to do with the money. So nothing's created yet.
Right,
We're going to do this. We're going to do it.
Right.
It's insane. But there's another avenue that's coming out, which I'm really excited about, was STO, security token offerings, where I can see a lot of small caps doing this, getting into this space instead of going the IPO route. And that's why I think you're seeing a lot of investment banks get in here, because what are investment banks? They're just a middleman, right? They're going to provide that liquidity for you. They're going to provide, give you a buy rating, 25 days after the stock comes out, here you go. But when you invest in private companies, it's 6-7 years before a payback period if everything works out, right? That's it's average if they go into IPO, which is a liquidity event, or if they get taken over. Other than that, you're sitting on it, and it's worse than housing, right? You're just sitting on it. You can't do anything about it. You can't get it out unless
It's a
maybe
it's a parking lot.
they'll buy you out for 10 cents on a dollar if you want, which is fine. But when you're doing these security token offerings and you actually have real companies doing this and offering an equity stake, which is backed by the token, I think that's a very good business model.
But what's the difference between that and
massive
an IPO?
Massive. An IPO, you got to pay 6 and 6. You got to give Goldman Sachs 6% of the deal, and you got to give them 6%. And to IPO, what do you have to do when you IPO? When you IPO with Goldman, especially now with the Ubers and look how long it took Facebook, Alibaba. I mean, these companies don't want to go public. They're 90% of their growth is taking place before they come public. Where now you have these smaller companies that no one's going to take public on our exchanges, because say if you have 5 million, 10 million in sales, people don't care. You have to have 100 million in sales, 20, 30 million in sales, or some kind of revolution idea for an IPO to come to market. And not only that, the massive cost in terms of lawyer fees and just registration fees and all this stuff, it's massive. And in this way, hey, you have a coin, it trades on exchange. Again, assuming that these exchanges, which a lot are coming out, I'm actually on a board of one that's registering with the SEC. But if this regulation takes place, now you don't have to pay all these fees. You can go directly to crowdfunding to generate this money. Some of these with the STOs are actually coming for accredited investors only, where you have a lockup period of a year, but your coin or the stock gets traded on the exchange 1 year later with maybe a tenth of the costs, and you avoid the middleman. So
that will be fine until the regulators get involved, and the very powerful lobby of the financial companies get involved, and say, like, you know what, that's fine, but we want a piece of this, and we're going to figure out a way. I'm just worried that they always do find a way to get money in their greedy hands and everything. So that's
I agree. I mean, they're investing heavily in the space because of that, because they're seeing the amount of money it's being. Everyone's doing these ICOs, are doing them overseas. You can't really do them here,
right?
Because they're not deemed securities. Some of the utilities, and if the SEC comes out and says, "Well, every ICO is a security," all these guys can't. Basically, going to have to shut down the business if they're in the U.S. So if you look at the ICO market, how much money has been raised over the past 3 quarters, even now, even when Bitcoin and these things have come down. These investment firms are going, wow, this could be a massive thing if this is improved America, or we're going to lose this business and everybody's going to find ways, because there's millions of ways to do this where you could open it up and kind of to U.S. investors. Again, there's a lot of backdoor stuff going on. You want it regulated, but they're avoiding the investment fees. They're opening up operations elsewhere. But now you have certain states like Wyoming, which is becoming like the Delaware of businesses. When you register a business, Delaware is one of the most friendly. That's why you see so many Delaware-based companies. They're not based in Delaware, but they register with the state of Delaware. Wyoming is becoming a state with cryptocurrencies, but it's going to be, if they do it right.
The wild west of Wyoming. That's perfect.
I know, right? In the middle of nowhere.
Perfect.
But for me, you know what? It's something that it's a really crazy industry, but I think really if you regulate see where it can go.
Frank,
cool.
you know where the money is. The money is in the PR and the the legal process to set this up. That would seem like to be the money to me, because if everybody that wants to come in and do this thing, and then you take a piece of the deal and you get, because crowdsourcing is great and crowdfunding is great. However, the problem is that we know that Goldman, if they do they have access to incredible amounts of money from all the hedge funds. The money is there. It is there. There's no question about it. Okay. If you do the other side where you don't have any crowdfunding, you're just using crowdfunding and you don't have any really ability to get out there. The company I would want to set up is the company that manages the entire process and helps companies get through the process, help them with the legal stuff, help them create the white paper and the website, blah, 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 get them registered. I mean, that's a company I'd want to be a part of.
Yeah, I know. But it's interesting. If it's like China, right? China is going to be the biggest and greatest economy in the world. It's just a matter of time. if they want to really regulate it and stop, the black markets and, not lie in everything that they do with the IPO scale that they had, again, a couple of years ago, 5, 6, 7 years ago, whatever. If they do things right, everything's accountable, then you're going to get tons of money flooding into that market. They're going to eventually be the biggest guys in 25 years. It'll happen in 10, but it's a matter then to get it regulated. I think I've seen the same thing, or that's how I feel from the people I'm talking to in this industry. Yep. But again, it is interesting. It's a fascinating market.
There's a lot of scam artists in here too, and some of them with very tall hair.
A ton, and that's why it's got to get regulated, because I would say most of the ICOs are going to fail. So you have to be very careful there, and but there are some of them that are actually pretty good that I've seen. But yeah, it is a crazy market. Now let's move on. One last topic here I want to talk about is like the FANG stocks and big technology, right? Because we used to see everyone is always concerned about the market coming down. They're like, what's a safe haven? Okay, well, it's consumer staples sometimes. Sometimes it's utilities.
Right.
People think gold. It hasn't been gold forever. But now it seems like the safety trade is getting into these these mega caps and these large caps, these FANG stocks. And I know you've mentioned that. What are your thoughts on that? I mean, some of these things are Tesla and Netflix, for example, great companies. I get it, but a lot different from Facebook, Google, Apple.
It's funny because I see Netflix as a company that you look at valuations and you're just like, whoa, what is that all about? But just hold on to that thought for a second. I look at a Tesla, for example. I look at the valuation. I say, oh my, what's going on there? Somehow I see a distinct difference. By the way, Netflix made my screen for our stocks that we hold in our core portfolios for clients. And I was shocked that it actually made the screen. You have to have good revenue, good growth, consistency and all that, margins, ROE that's expanding. It made my screen. That was pretty impressive, okay? Tesla, on the other hand, seems to be just a major Barnum and Bailey hype job. And to be honest with you, I am not saying anything really, well, I guess I am to a degree, but about Elon Musk, brilliant guy, smart guy, having fun with the whole process and all that. But a lot of talk, and the delivery issue is a real question. The production issue is a little bit behind. In order to make his deal, he's laying off 9% of his workforce, announced yesterday. There's a lot of things that are going on that I just, it seems like a constant, major, look over here, not over here for the company. And they're gonna have massive cash burn for a long time. And even while they have some benefits from their batteries and their solar and all that, they came in, they basically bought a defunct company with the Solar City, and they had to bring that in because that thing was going bankrupt if it didn't. And he rescued the company, and you have that going on now. But the car, brilliant car, fantastic car, great car, wonderful car. Nothing about the car. However, it is a car. It's a car. And I get it's some technology there, but it's a car. It's a product. So why are you valuing this thing so high like that? It is beyond my wildest understanding. Unless what he's trying to do, which I believe he is, he's trying to do the Amazon model, which is to spend the crap out of money, lose money, who cares in the beginning, and then when you finally get
difference, though. Amazon could really, as you saw last quarter, Amazon could report monster profits if they really wanted to. They just pour a lot of money into the business. This company can't report monster profits even if they wanted to.
Right. Well, that's why they're laying off 9%. That's why they're laying off 9%.
But the stock's going up. Hey, they love that news. It's been up 15%.
I know it's going up. It's at 345, give or take 343. I mean, I still think it's a questionable. I can't like them. I just can't like them. I'm trying. But
it's
get
dangerous. Real quick, to get back, before you do that, I want you to explain something, because now you're seeing Tesla, which was what, 275, 280, now it's going 310, 325. Could you explain, as someone who's a trader, of why you're seeing this continue to go higher? Because this has one of the biggest short positions out of any stock in the whole planet. So I won't even there. Yeah, close one. I almost slipped there, but you know what I mean. But explain why, because once it goes high, there's a chance it's going to continue to go higher, right?
Right.
But I want you, as a trader, talk about that.
So it's interesting because you look at things. Okay, as a young trader, novice trader, you're looking for, all right, what stocks maybe won't be so good. Let me find those stocks that I can possibly short. And you start looking at things like, oh, look at that. There's a lot of short interest on there. Maybe there's something called, days to cover. How many days of normal volumes does it take for actually all the shorts to get covered? So let's say you have something with 10 days. That's a long period of time. A stock goes up. What happens is certain traders are short, and they get their level that they say, that's the level, whether it's technical or some other level. That's the level I'm going to buy. Once you buy, obviously it takes the stock up. And as more and more shorts are in there, and you have such a heavily shorted position, just inertia that starts moving it up, starts busting the stops on shorts, and you start getting a move higher. Same thing is in reverse of what happens if you have a lot of long positions, that the stock moves down and starts moving down and moving down and moving down. The difference is that with a short position, you could lose an unlimited amount of money, and people don't want to be a part of it. Most short traders are, they're kind of renters. They don't really buy and hold, or short and hold, I should say. They're kind of like, looking for a drop and then getting out. And by the way, for those of you that think that short sellers should be locked up, you're nuts. They're the people that actually save the markets in the worst of times. As markets are careening lower and you have a lot of shorts in there that are cleaning up and making money, and nobody wants to buy, it's the shorts that usually come in and say, okay, we're closing our position, and that's a buy. And that's when it starts turning things around. And when it starts moving up, the shorts pile back in and start selling even further. And what happens is it brings prices up. So when you have a very high short interest on a stock, if there is inertia and there is buyers coming in, not only do you have natural buyers that are buying the stock, pushing things higher, but the shorts are actually covering their positions and pushing it higher. And oftentimes the shorts will chase it really fast because they don't want to lose any more money. So they're going to, buy at any price on the way up.
No, I'm glad to explain that. I love giving, anything we could teach you guys out there. It's just cool. But okay, so you said, back to my point with this being a safe haven. Go there really quick.
So real quick, you have cash cows here. You have Microsoft. This is making money hand over fist. They just bought GitHub. They think they're going to do something there. They got a lot of money in the bank. They're doing buybacks. Apple, massive buybacks. You have these companies that have money in the bank, ability to issue debt, and they're doing buybacks. You know what? Let me think. Do I want to be over in the emerging markets that are getting kerplunked? Do I want to be in some stocks here in the U.S. that maybe are in the utility market that are susceptible to interest rate moves, or maybe even real estate, maybe not, oil, all over the place? You know what? Let's go into some of these cash cows that are just able to make money regardless of economic. Listen, is Facebook really going to be necessarily affected by economics? There's maybe a little bit, possibly, there's other things that will probably affect them. Microsoft, people need their computers, maybe, with less people working, less seats mean less business. Okay. But they still have a lot of cash, a lot of buybacks going on. So people are, I think, seeing this as a safer haven because of that, and kind of moving there. And that's why we're seeing markets go up also, because we have market cap weighted indices that are moving things higher.
No, it definitely makes sense. So let's get some of your favorite ideas, which I like to do all the time. You're always at one out there that throws favorite ideas, and now we created this all-star portfolio where, just like you do when you monitor my stuff and everything, we're kind of throwing the stock pick from all the all-stars that we call it all-stars, guys like you. You're in that group. You're an all-star.
No, yes.
But what is some of the things that you're trading, some of the things that you're looking at right now that look like good ideas in this market?
I mean, Facebook. Again, I'm not. Facebook, I would just love to short. I got to figure out the right price here. Let me tell you one that I think is really interesting for something right now. Generac, GNRC, is a generator company. We're entering into hurricane season. It's a seasonal trade that seems to work on a regular basis throughout the summertime. Now, of course, if the more hurricanes you have, the more generators, the more fear of hurricanes, the more generators. And since we had a pretty bad season last couple of years with Texas getting killed and Florida and all that, people could be stocking up on generators. They don't think about it the rest of the year. They think about it the first time the first hurricane comes. That's when people start thinking about generators. And you'll watch the company start ticking higher usually when there is the threat of a storm coming. So Generac I like as a company, generally speaking, and as a seasonal trade. Brazil is an interesting area, down pretty hard from its highs, down about 28% from the highs in January. And I think that this whole truckers route and the Petrobras situation and some of the corruption issues, of course, but the Petrobras with raising the price of fuel on a regular basis, they're going to kind of get the notion that can't be done. They're going to realize that truckers need to be subsidized. Things will calm down a little bit. So you can look at EWZ as the Brazilian ETF that could have an opportunity moving forward. So 2 ideas for you.
All right, perfect. And Andrew, if someone wants to get more information from you, your Disciplined Investor podcast, I always say it's the second best podcast ever. But no, and we've been doing this for a long time together. Even back in the street and stuff like that. We've been friends for a very, very long time. But guys, go take a look at Disciplined Investor podcast. But also, you're always working on things too. If someone wants to find more information out about you, how can they do that?
You just go over to the disciplinedinvestor.com. There's all the different things that we have available there. All the podcasts are there, the various strategies. You can watch some videos on the strategies. You can find out what's going on with our global allocations, our hybrid robo Investology with an E, Investology is a platform that we created that brings the best of the back end of robo investing, as well as what we're doing on actually managing your portfolio. Check out everything right there. I have one question before you close. Can I ask one question?
You can ask whatever you want, pal.
So I have a client that he listens to you, and he says, that in your newsletter and several other newsletters, they're talking about uranium and becoming high demand. He said, however, the question is, he said that somebody said that Kazakhstan and several other miners have reduced and continue to reduce production capacity. Therefore, I don't understand why the price of uranium is going to rise if miners can just increase production to meet demand. And therefore, prices would only up to slightly. So can you give me just a little bit on this whole uranium thing?
You're waiting for demand to come around, but that's a big story, right? You need some of these things to come back online in Japan. But I could tell you this, guys, and I'm being dead serious here. Michael Alcon is the #1 rated uranium analyst in the world. I'm not even kidding you. I'm not hyping that up.
We can say the universe. You can say the universe.
I'm telling you, no, but I'm being very serious here. He's created models, and I've seen this, guys. It's amazing. It's unbelievable, to the point where he has some of the largest hedge funds in the world calling him about it. He's meeting with all uranium companies. He is the uranium. He's speaking at uranium conferences, but he did a couple of presentations, and now it's going viral. He's the person that this is a massive market. It's going to be a massive market soon, and he's very bullish on it. It's going to take some time, but he is the guy that if you want to talk to uranium, he knows everything. I mean, you can follow him on Twitter and go there if you like, but he's the guy that knows much more and gives me all the analysis. So for me to give it to you, I'm kind of like taking him, again, Mike Alcon runs Money Flow Trader. He's, we hired him. He's amazing. But he's the uranium specialist, and to the point that, hopefully he doesn't get too good where he leaves and starts his own uranium hedge fund. But,
well, I did try to poach him from you. He said he's staying. So
cool. Thanks, bro. Thanks. But yeah, he's a guy to know about. But yeah, I think prices will eventually go higher. It's a very long-term story, and it's something that you want to put money into it and forget about it. And in 10 years, you'll probably be extremely happy, because when this market turns, you don't get 100% gains. You get 1,000, 2,000, 3,000% gains, especially from this price, because it's not economical right now. So they have no place else but to go higher, and they will. It may take a couple of years, but it will. Okay. So hopefully that answers your question.
And one more thing, you can follow me on Twitter. That's the other part of the answer to your question before I asked you the question. Andrew Horowitz, just one word, Andrew Horowitz. And by the way, I have a new Instagram account. My kids made me
Instagram. Love it.
Yeah, it has nothing to do with finance.
So people are just gonna. Okay, cool.
It has to do with it's called Dad Bod Food Blog. It's all my food pictures.
Oh yes,
from around the world.
Chef, and you have a lot of talents out there that we should be talking. We should talk more about that. People are interested in stocks these days, right?
Yeah, I guess.
That's another podcast for you, man. That's a good idea. Well, Andrew, listen, be safe on your trip when you go fishing. Thanks. And that 70-mile trip's interesting, but I always love when you come on. You always give us ideas, insight, and we can really talk forever. So I really appreciate it. I know everybody loves you on the podcast, so thanks so much, man.
Frank, you're the best. Thanks for having me.
All right, buddy. Take care. Hey, guys, great stuff as always from Andrew. Give out his Twitter address, a whole bunch of products and stuff and things like that. I always give him time to really plug some of his services and things like that. But he's just a good friend, a guy that I trust, someone that really cares about his business, that cares about. It sounds crazy, right? Because you think everyone would care about their business, but he really does. He's got great credibility. Someone I know for a very long time, has a great podcast, and has been a very good friend. So I just love talking to him because we go anywhere. Right. And it's great analysis. It's not like, oh, okay, let's just talk about this and talk about it. No, you can tell it's detail. He's going into it. This is what he loves. This is what he lives and breathes. And to have him come on and talk about so many different sectors and different stocks, it's usually why I get the best feedback from him. But this podcast is about you, not about me. So let me know what you thought. Frank@CurzioResearch.com. That's Frank@CurzioResearch.com. So run out of time here. Long interview, great introduction by AT&T, and kind of like that education segment right there. But I want this to end with this and say thank you so much. I mean, demand for crypto intelligence, Barry Cohen's newsletter has been off the charts, and it's been incredible. And we offered, a free treasure, which is a cold storage device. We also had a special offer, 80% off for subscribers. We ended that on Wednesday, and we're getting a lot of demand from affiliates that want to run this, and I don't want to do it yet. I'm going to run it to them probably starting in a couple of days. So I wanted to extend this offer out, and I usually never do this because Whatever our offer is, but we're getting a lot of emails because there's some people out on vacation and some people that do this, and I went to sign up and they say, well, I didn't get that offer that you had 3 days ago, and these are people that have listened to me for 10 years. We're going to keep it open just for a couple more days, guys. That's it, and it's over. Again, we want to do the right thing by our clients and get you into the right newsletter here instead of you going off and buying some other newsletter with guys that I know in this industry that don't know what they're doing. So again, it's not a sales pitch. It's not anything like that, but we're still going to open it up where you're going to get the free Treasure cold storage wallet, and you're going to get 80% off of the newsletter. And after that, I believe it is on Friday. It's ending, and you won't see that offer anymore, maybe ever again. So, again, we'll keep it open for Friday for you guys. And most of you subscribed already. This is just for a lot of emails, maybe a couple of dozen or so people saying, I wish I took advantage of that offer or whatever. That's for you if you want it. You have to be on an email list. You just go to CurzioResearch.com and get an email list, or send me an email, frank@CurzioResearch.com. But guys, thank you so much. The demand has been off the charts. And I think you're going to be really, really happy, especially for getting in right now, because he's going to come out with Barry's coming out with great recommendations, and it's at the right price, and it's doing good now. We saw a little bit of decline in crypto right now, and mostly in Bitcoin, Ethereum, and some of these things, but it is going to provide a great opportunity. And it just shows you why the market came down, is because another market in Singapore got hacked. And we need more regulation in this industry. When that happens, you're going to see tons and tons of institutional money flow into this market. Guys, I know this directly. I talk to people who manage other people's money, who want to get into this industry, but they need to see regulation first, because they had that fiduciary responsibility where they can't just close their eyes and invest money in it. So companies that are coming to the market in crypto that are actually trying to register with the SEC, that's becoming a big thing. So big that after this podcast, I'm going to go home, change. Tomorrow morning, 4 a.m., I'm flying to New York to meet with a lot of people, family offices, and about 7 different crypto companies. And it's a huge event because these family offices and the person who's going to be there represents about 1,500 of them. Their clients, his clients, want to get into crypto, but they want to do it in a way that's responsible. They want to do it in a way that it's regulated by the SEC. This way, there's no BS, and you can see how much demand it is. So I'm going to New York for 2 days, actually talk to a bunch of people, meetings all day Thursday and Friday, and I'm flying back here Saturday morning because it is Father's Day weekend. But, and I'll give you, the scoop on what's going on, what I learned from there, because I want to hear what they're saying, what they need to see, because that's what I'm hearing from institutions out there, how they want to get in. They need to see regulation first. And the SEC is not too far off of creating regulation in this industry, which it definitely needs. Not over-regulation, but just provide those levels of safety for every investor to feel comfortable buying Bitcoin, buying Ethereum, buying these ICOs or STOs or anything else. So thank you so much again for all your support. I really appreciate it. So guys, this is for me. Thanks so much for listening. I'll see you in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.